Welcome. You're watching All That Glitters right here on BloombergQuint Live, and I'm Devina Khanna. Well, the last few months of global and domestic market uncertainty has led to an increase in investments in safer haven asset classes. One asset that has seen a real sparkle is gold. From last Diwali to now, domestic gold prices have moved up by almost 20% compared with the Nifty, which since last November is up approximately 10%. We will be discussing all the various factors impacting the pricing of gold with our three special guests who will give us a more holistic view on what is supporting the move on the yellow metal. But before that, let's just take a quick look at the journey of this precious metal from last Samvat to this. And like I said, domestic gold prices have seen a move of about 20% from last Samvat to this Samvat, and Nifty for itself has been up only about 10%. There are a few characteristics which identify with gold in terms of, how this is a safer haven investment and the characteristics of that. First, gold has delivered better long-term risk-adjusted returns compared to most asset classes. As you can see on your screens, if you were to compare it with cash, bond market aggregates, US stocks, whether you compare it to emerging market stocks or whether you compare it to commodities, and this is over diversified periods of time. So since 1971, over the last 20 years as well, as you can see, gold has been that big graph there, that big bar there that has really outperformed all other asset classes. In the last 10 years, well, it's really managed to stabilize, if not give those exceptional returns, but the last 10 years have also been pretty good for gold as a whole. In terms of, talking about gold prices and the outperformance, particularly in periods of low inflation, gold tends to do well, and this is exactly an example of that. Gold also has low volatility, and that is also another factor why it is considered one of the more safer haven investments. As you can see, across the board, across various commodity classes as well, gold has one of the least volatility. If you were to look at energy, if you were to look at oil and gas, whether you look at silver pricing, whether you look at platinum pricing, across the board, if you see the second last category there in terms of overall volatility is gold. Aside from that, it is also a proven store of value. It is a highly liquid asset. All of these factors adding to the sheen of the yellow metal, aside from the fact that, these times where equity markets are a bit uncertain, the money keeps going into safer haven investments. Talk about all of this and more. Let's also get in our experts on the show then. I have with me Mr. Somasundaram, PR Managing Director, India World Gold Council, and Sandeep Kulhali. He's the Senior VP Retail and Marketing, the Jewelry Division of Titan. Along with him, we also have a very special guest, Alex Muck, who will be joining us in just a short while. But let me come down to talking about the inherent demand at this point, and how is this Diwali compared to the last Diwali? Mr. Somasundaram, we know that it has been a slightly subdued festive season. Demand, because of the elevated prices, has come off a bit. But how is the situation on ground?
Well, we hear that it is much better than it was during Puja holidays. Footfalls have increased, and jewelers generally seem a little happy that customers have started coming in. But as you rightly pointed out, the price levels 20% above, in the last few months, is acting as a severe headwind for any substantial increase in demand. So our expectation is that it will be subdued. It will continue to be subdued. It will be better than what it was last quarter.
Speaking to some trade body officials, Sandeep, and this one is for you, it seems like the demand for this Diwali and Dhanteras could be as low as 40% compared to the previous year. Do you feel that? Do you see that on ground?
Yeah, I do agree that the demand the first 6-7 months, including pujas, have been dampened largely because of July month. At least for us, I can speak for the brand Tanishq and Mia and Zoya brands, that the July month has actually pulled on the entire growth story for the company in terms of its very healthy double-digit growths. And July 1 month has pulled back a quarter 1 and quarter 2 growths, whereas August, September, and April, May, June have been extremely good for us. Because, like I said, Tanishq is in the space of market share gain, and all the good work we've done in the past seen traction for the brand. And the July month has pulled down our growth. Therefore, we are growing even as we speak, but it was very subdued growths compared to the plan that we had for the year. And more importantly, what's interesting is the last 5 days I've seen a real good surge in demand. It's growing much more healthier than last year. Actually, as a matter of fact, they're growing close to our targeted numbers of growth in the last 6 days compared to the same period last year for the festive season, if I use the word. So we compare exactly Diwali backwards till Dussehra, and those periods of sale, we are clearly seeing a double-digit growth fueled by last 5 days of demand.
All right, and the steep increase in prices are no hindrance to customers coming in and spending?
No, like I said, one interesting fact has been that this gold rate in July has seen the peak of the gold rate. And typically, you have seen in the past when it hit the 2,000 number or 3,000, the consumers become the new normal. And last 3 days, there's been a decline in the gold rate, but still substantially higher than last year, about 2,000 rupees per gram reduction in the last 4 days. But so it's taken off some pressure of the rate of gold. And therefore, I'm seeing, and plus, one is seeing a new trend in the market where consumers are shopping closer to the date of the festival. So it's been not earlier days of 2 weeks before Dhanteras, pre-sales pick up now, last 4 or 5 days, and tomorrow is Dhanteras. And we're seeing the peaking happening really well in the last 5 days, and we're expecting a very positive Dhanteras for us tomorrow.
Mr. Somasundaram, comment on the Indian gold exports, which have also come off quite significantly on the back of higher prices, and also another trend that is being spotted due to these steep prices is that there is more recycling of gold happening rather than fresh purchases.
Yes. First thing is on the export front, of course, what India has seen in terms of price increase, every other market has seen it. So what we are seeing as pressure on demand is also faced by other markets, a physical demand. It's only ETF inflows, which we have seen, which is driven by investor sentiment, which has actually risen very, very fast. The other part, the jewelry demand and coins, bars and coins, remain subdued across all geographies, actually. Now, coming back to what's happening on the export front, India has never been yes, jewelry exports have been shown as big, but quite a lot of it is also not very. It's not a sticky demand, and it's done more to the Indian diaspora outside. So I think that fall has to do with the prices, and there is no other significance to it. We need a lot of infrastructure to increase exports. Bars, India refineries are unable to do so because of the high margin requirement, and that is something which is a regulatory change that is expected.
There's much more interest, Mr. Somasundaram, that's coming back into gold ETFs. Do you think that's going to be a preferred mode going ahead instead of just the physical gold and jewelry?
Well, as you know, ETF is also physical. It is allocated gold. It is kept separately. So it is not a promise to give you gold. It is gold. It is held in gold bars with a custodian. So, but yes, it is not held in the households. It is so that is definitely, we have seen huge inflows primarily in the US and Europe. Various reasons, Brexit and the anxieties around their economies, the US interest rates. So we have seen substantial inflows in the previous quarter as well, and we are seeing the same trend this quarter, the quarter 3, and that trend seems to continue because gold is the best performing asset class today, and you do see not only the long-term investors, even the short-term investors are actually moving quite a lot of inflows into gold. So yes, ETF continues to be a very attractive investment mode at the moment as compared with bars and coins and jewelry.
Okay. Sandeep, what's your understanding of what demand could look like from a medium-term horizon despite the pricing?
I think it's a positive time, and this is the best part of the year for jewelry buying because historically the second half has been the most stronger part of the jewelry buying periods. And the high of the gold rate of July is in the past. There are lots of wedding dates starting from the season now, right after Diwali. There is a series of wedding season going right up to February, March. And like I said, the gold rate now is a new normal for consumers. And yes, there is a tentativeness in the consumer's mind for sure, largely impacted by the overall economic conditions or lack of spending confidence of consumers. That's the only piece which I'm seeing likely to impact demand to a certain extent. But see the wedding dates, you see the performance of jewelry doing better than coins, for example, the moment. Diamonds doing better than gold at the moment as we speak. The growth rates are higher than gold. I foresee a reasonably good demand, but yes, it will be muted to the extent that it won't be those healthy growth that we've seen the last 3 years post demand that we saw. May not be there as last year growth rates, but it's going to be a positive in terms of growth over previous year is our expectations of the balance 6 months.
Okay, that's the second half of the year. But Sandeep, you spoke about how there is still interest coming even at these prices for gold jewelry. But if you were to actually make a comparison to Diwali, even while much of the demand will start coming in closer to Dhanteras and the actual Diwali day, you see that pick up in those 4 or 5 days of the actual festival. How has it been so far? You've been able to gauge it, since Dussehra, since the puja has started. So how has that been? And the run-up to the main Diwali days, how has that been?
See, like I told you, I mentioned we do tracking. We do exactly like tracking. Our data is not October month to October month. We are comparing what we call as Navratris to Diwali. That period, the 30-day period of last year, we compare with this year, right? And if I look at that rolling block, it has a slow start. First 15 days post Navratra, it was a very slow growth. We are wondering whether this gold rate is really going to impact us adversely. But interestingly, it started picking up. Pujas did very well for us in Calcutta. But last 6 days, last Friday onwards, we are seeing a very different traction on consumption. It was from I can't give numbers right now at this stage because we were board meeting, but I can tell you it was a surprising growth from flattish to a double-digit growth in the last 6 days. The same period for the entire duration of Navratras to, as we speak, yesterday, equal to the same period last year, 1 day before Dhanteras to 15 days back. We do exactly the same period comparison. That's the positivity one is seeing in the market for Tanishq brand, that we are seeing a big jump. Especially, like I mentioned earlier, this is to do with people shopping closer to the date of the occasion. Yes. And that is seeing very, very often. I'm seeing this happening closer to wedding dates, closer to Dhanteras, closer to Dussehra. Last year, Dussehra also was the day of Dussehra, and the day before was the peak. Before that was very dull. So those are the belief that we believe that it's really going to take off. And last 6 days has belied our fear that the growth won't come back. But we are seeing a growth, clearly double-digit growth, compared to festive period comparisons.
All right, that's very encouraging to hear, Sandeep. Mr. Somasundaram, last question on this discussion. Obviously we know that World Gold Council is optimistic with regards to gold prices going forward as well in terms of the second half projections too. Do you believe they're sustainable?
Well, as you know, that we don't forecast prices at all, but yes, we do give factors which affect the prices. Looking at this, the U.S. interest rate scenario, the global geopolitical situation, which included trade wars, and the central bank buying. These are the three drivers of gold price at the moment, if you look at it, and none of them are going to disappear in a short run. They are here to stay as we see it. Central banks continue to keep buying gold. All the central banks, including RBI, has bought it. The trade wars don't seem to abate. And the US interest rate scenario, we all know, has taken a 180-degree turn. And that's going to continue. So given all these factors, yes, the drivers of price and demand seem robust. Demand will face some headwinds, as Sandeep said. People will get used to the new normal, and because of the season, there is a stickiness of demand, and that too will come back. And as we have already done a study in the past, gold demand in the long term is more is affected more by income than by any other factor. And we all know that incomes are going to keep going up in India because of our GDP growth. So it is sustainable, I would say.
All right, got that. Mr. Somasundaram and Sandeep, thank you so very much for joining me on this special discussion on gold and what lies ahead. Also joining us on the show is Axel Merck, President and CIO at Merck Investments. Axel, thanks very much for joining in. Let me start off first by asking you, now gold has proved to be one of the best asset classes this year. Will the optimism around the yellow metal continue, according to you?
Yeah, so we see several different types of investors, and they are in different phases, so to speak. One is the investor that likes to just diversify their investment portfolio. And in some ways, investors like to have their cake and eat it, meaning they like to have their risk assets, their equities, and by adding gold to their portfolio, they have a reasonably volatile asset, and they don't have to add much to get the diversification. So those investors have been there continuously. Then there's the other type of investor that is very sensitive to real interest rates, meaning that the one thing gold that does not pay a dividend with competes with are bonds. And when bonds are rallying, when yields, especially on the US 10-year, is low, then gold tends to do well. And that is very sensitive to tensions in trade, because when there are tensions in trade, US trade tensions, then bonds tend to rally, and that is a good thing for gold. And so the easing of the trade tensions that's anticipated, and the further easing, is a headwind to gold. And then there's a third one, of course, on the short end, there's the Federal Reserve. What I see ultimately playing out is that this is not going to be a straight line. It's in the president's interest to have trade tensions in the news, but at the same time to ease them a little bit. And then ultimately, the last thing, of course, that aside from the physical demand is that we do have potentially inflation coming back into the system. That's something that's a fairly low probability scenario, but I wouldn't rule it out. We have lower interest rates. If we have an easing of trade tensions in addition to that, we also are adding hundreds of thousands of people to the job market late this year for the census. And so if this economy does not fall into recession in the US, but does improve, that could create quite some volatility in the markets and ultimately be beneficial for gold, but it's not going to be a straight line.
Since we were talking about the Fed, Jerome Powell flagged openness to further, the rate cuts amid global economic risk, and said that it's time to allow the Fed's asset holdings to begin to expand again. How does that play out for gold traders, according to you?
Yeah, so let's talk briefly about the Federal Reserve's balance sheet. The increase in the balance sheet, on the one hand, is really a technical issue. It's because the short-term rate market isn't functioning the way that the Fed would like it to be, that the money isn't making it to the right places. And different from QE, they're buying treasuries. Now, in some ways, it's technical. It shouldn't matter. That said, I think the Federal Reserve has been particularly bad in communicating what their strategy, partly because they're making the strategy up on the fly, which they have been doing ever since the financial crisis. I think it would be far more beneficial if they changed a lot of the holdings from holding a lot of long-term bonds more to a short-term end. But the short of it is, yes, the Federal Reserve balance sheet will be growing, and indeed global balance sheets are growing yet again. And so yes, that will be supportive to gold. It is not going to be as significant simply because it is mostly technical, but I do think yes, the signs are that we are printing money again.
All right, let's talk about the other factor, which is central banks loading up on gold reserves. China has added almost 100 tons of gold to its reserves in the last 10 months. Other central banks have also witnessed record purchases in an effort to diversify reserve assets. Does that lend good support to the prices?
Yes, well, there's on the one hand several countries, including China, some Eastern European countries, a few other countries have been buying gold. I think that is supportive for the price of gold in the medium term. And then very notable, it's not a large amount, but Germany just disclosed that they increased their gold holdings. That's the first time in many, many years. And while it's a small amount, it shows that a country that's faced with negative rates might be willing to go down that path. I mean, we have to see whether that's going to go and ramped up to bigger amounts. But there's, on the one hand, is the negative rates that motivates some of these countries. But more importantly, I think many countries are looking for an alternative to the dollar. That is not easily had. It is the U.S. markets are the most liquid markets. And as countries are struggling to find alternatives, gold is a beneficiary of that as well, yes.
You know what, if we track the CFTC data, Axel, it's been showing a lot of long positional build-up with regards to gold. Do you feel then that this move that we've been seeing is also on the back of some speculative positions and it's more speculative in nature, or do you actually feel that these prices are sustainable from the medium to long-term perspective?
Well, when gold is out of favor, nobody wants to look at it. When gold is in favor, everybody jumps on it. And so that comes with gold, partly because there isn't so much fundamental analysis, meaning people do. They look at technicals, and so everybody is kind of jumping on the same trend. And yes, that can exacerbate trends, that increases volatility. Historically, volatility in the price of gold is reasonably high, and we've seen only a little bit of that, and I think we'll see much more of that. Ultimately, the CFTC data, the speculators data, they always come out with a lag. They are but one of the items one can monitor. I think the bigger indicators are really risk sentiment data. I should have mentioned earlier, if you have a bear market, gold has historically done well, and the reason is that when you have a bear market, volatility tends to go up, and when you have a cash flow, like in equities, then you have a greater discounting of that cash flow. And the quote-unquote good thing about gold not having a dividend or cash flow is that there's no greater discounting, so it tends to do well during those scenarios. So I think volatility is there a better, if you want, a technical indicator rather than the CFTC data. But yes, it's something to keep an eye on, and indeed, often when those positions pile up, you can have a reversal.
And specific to gold being a safer haven investment asset in times of uncertainty and economic slowdown, with the IMF recently cutting growth forecast for India as well as Asia, what do you think the impact of that's going to be like now that you still have the trade talks as well as Brexit looming large?
Well, in some ways, of course, uncertainty, as I just mentioned, when it translates to volatility, that tends to be good. That said, the market has a way of getting used to things. You would think so, at least. So the terrorist attacks we've had, they used to push the price of gold higher, and unfortunately, those things have become a routine. Similarly, in some ways, Brexit has become this permanent story that will never end. Now, all that said, indeed, what we've seen in recent weeks, the equity markets actually have become more sensitive to what's happening with Brexit. Now, all that said, the one thing, of course, yes, I mentioned early on that the easing of trade tensions might be a headwind to gold. So similarly, the easing of Brexit tensions might be a quote-unquote headwind to gold, as there's more certainty about the future. All that said, individual investors seem to be, in the US at least, according to surveys, most uncertain about what's happening. There's a lot of policy uncertainty. There's a US election coming up. So we can always pick our favorite uncertainty that we have. I think ultimately we do have gold as a diversifier for those who want it for equities. And then the question is the interest rate side. Will real interest rates, those net of inflation, move higher? And even if we have a little bit of an improvement in that, if we have an easing of Brexit uncertainties, I do not see how the current Federal Reserve in particular is willing to do that. Keep in mind that one of the things I'm concerned about is, I mentioned inflation just briefly. The reason I'm concerned about that is because wages, they haven't gone up substantially, but we are around 3% year-over-year increase, and unemployment rate is at record low. I'm concerned about inflation, but the Federal Reserve is not at all. They say, oh, higher wages is good for more purchasing power, and that's of course true to an extent, unless you run out of workers that you can hire. And so it's those sort of uncertainties and those sort of risks that I think will be the bigger driver of gold. And again, I don't think that the price of gold is going to shoot through the roof here because there's an easing of the tensions, but all these dynamics as they play out, I think in the medium term will be supportive for the price of gold.
Let's narrow it down to India then. India as a country has its own fascination towards gold jewelry. From a demand standpoint, how do you see the dynamics playing out with regards to whether you see the demand outstripping the supply?
Well, the Indian consumer is quite sensitive to the price of gold, and yes, the Indian consumption, if one can call it as such, of gold does have an influence on the price. Sometimes we're too focused on CFTC data, the wedding season in India and all that of course has an influence. Now, just a word on demand and supply maybe in general. The large gold mining companies have substantially underinvested in recent years. Now, they'll quote-unquote fix that probably by acquiring smaller players. And those sort of dynamics will just exacerbate the boom and bust cycle we've had in the industry. Whether or not that in itself will influence the price of gold remains to be seen. But as the price of gold goes up, yes, more projects get funded. We see a lot of funding of small projects. Now, that doesn't translate to more supply tomorrow because many of these projects take many, many years. But that's part of the reason why you have these bull markets last for many years. As the demand is picking up, as we see now, there isn't enough supply. But ultimately, a few years down the road, we'll probably have too much supply again when we're at the tail end of the current bull market.
You know, while you already mentioned that you don't really see a runaway move on gold, but where would you place your medium-term targets on gold?
Yes, when we prepared for this interview, you asked me this question, and I dodged the question simply because it's always very difficult. We reach a target, and then we go away from it again. I do think that it is quite likely that we'll be here in a range that's going to be no more than about 5% down, but potentially 10% up from here. I do think that 1600 by the end of next year is quite possible. Where we'll be at the end of this year, I don't have a crystal ball because so many things can work in so many different ways, and some are very good for the economy, some are very bad for the economy. The key thing I'm looking for right now is in not just Brexit, but the trade deal with China, the phase 1 deal, to be actually signed in the middle of November. And depending on how the markets react to that, if the Federal Reserve is quite likely not going to cut further in December, and so I think that we might be range bound for the end of the year, but it all remains to be seen. There's always something that can surprise us from some direction.
Okay, got that. Axel, thanks very much for joining us. Really appreciate you taking out the time with your thoughts on what you feel gold could do in the medium to long term. Well, and that's all that we have here on this special telecast with regards to gold and its journey so far and what's anticipated with gold being the safer haven asset class that it is, at least in the current times of volatility compared to the equity markets. Thanks a lot for watching.